Everyone dreams of passing down their wealth to their children, but here's the cold reality. If you don't know the right moves, the IRS is waiting to swoop in and claim a massive cut the moment you're gone. I know that's not the legacy you've worked for, so today I'm going to teach you exactly how to prevent the IRS from taking everything you built so you can give it to your children the day you die. Let's dive in. I'm going to start out with real estate because for millions of Americans, this is the single largest asset that they pass on to their children when they die. And in fact, at the time I'm recording this video, the average home price in the United States is around $450,000. Many homeowners in their 60s, 70s, and even 80s face dilemma. They can either pass on their property before they die or after they die, and they don't know which is better. If you pass on your house to your heirs before you die, you can accidentally expose your heirs to substantial capital gains taxes that they wouldn't thus otherwise have to pay. This is due to a very important tax provision called step-up in basis. A step-up in basis is a tax rule that resets the value of inherited assets like houses to their market value on the day the original owner dies. So for example, if your dad bought a house for $100,000 20 years ago and it's worth $500,000 when he dies and you inherit it, your new basis would be $500,000. Now, you might say, Karlton, why does this matter for tax purposes? Step-up in basis matters for tax purposes because it dramatically impacts how much capital gains taxes your heirs owe on the property. It can either be a huge amount or nothing at all. You see, when an asset is stepped up in basis, it means that the new cost basis for tax purposes is the stepped up value, not the original purchase price. So to go back to the example I just mentioned, the dad experienced a $400,000 capital gain when his property increased in value from $100K to $500,000 over 20 years. So ordinarily, this would be resulted in long-term capital gains taxes on the $400K, which will come out to around $80,000 in taxes. However, if the dad just held on to the property until the time of his death, then the cost basis is automatically reset or stepped up to the current fair market value, which would have been $500,000 when the asset is passed on after death. So listen very closely here. What this means is that if you own property, you could potentially save your children or your other heirs tens or even hundreds of thousands of dollars of capital gains taxes by waiting to transfer the property to them until after you die. When you do this, your children will get the benefit from step up in basis instead of owing capital gains taxes on the entire price appreciation that occurred when you held the asset. So this means that they could owe zero capital gains taxes if they sell the property right after inheriting it. Which would you rather have? Your children pay $80,000 in capital gains taxes or $0? I'm gonna guess it's $0. Now, I made a similar video to this one a few months ago about step up in basis, and here it is right here. So make sure you watch this one too if you haven't seen it yet. But when I made this video, I noticed that there were several questions that kept popping up in the comments. So I'm gonna answer 3 of these questions to help give you guys a better context and clarity on this situation. Question number 1 was, what about a ladybird deed, which is also called an enhanced life estate deed? It is an estate planning tool that lets a property owner pass their home to beneficiaries after death without going through probate. With this type of deed, the owner keeps complete control of the property during their lifetime, including the right to sell it, mortgage it, or even revoke the deed entirely. It also helps ensure the property avoids probate and can provide protection from Medicaid recovery. However, ladybird deeds are not available everywhere. They're limited to just a few states. Florida, Michigan, Texas, Vermont, and West Virginia actually are the only states that offer it. So if you happen to live in a state that allows ladybird deeds, then yes, you can use them. And yes, your home will receive a step up in basis after you pass it on. The rules do vary slightly from state to state though, so you will have to read up on the ladybird deed rules for your state if you want to go this route. Now, question number 2 was, what happens if my children want to live in the house and not sell it? So if you pass the house on to your children after you die, then they will only start owing capital gains taxes on the appreciation that occurs after the basis is stepped up. So if the basis gets stepped up from, let's just say that example we had, $100,000 to $500,000 when they receive the property, then they will only owe taxes on the appreciation that occurs above the $500,000 cost basis. So for example, let's say that your daughter inherits your house after you die and lives there for 5 years, during which time the $500,000 value of the property, which has already been stepped up, appreciates to $1 million. In this case, your daughter would only owe capital gains taxes on the $500,000 of appreciation that took place during the time that she lived there, which leads me to my 3rd question, which is, would my children qualify for the capital gains exclusion? So the capital gains exclusion lets you exclude up to $250,000 or $500,000 for married couples of profit from the sale of your primary residence from the taxable income under certain circumstances. So the circumstances are very simple. You must own the home for at least 2 out of 5 years preceding the sale as a primary residence, and you must use the home as a principal residence for at least 2 out of those 5 years preceding the sale. So if your children move into the house, then yes, they can potentially qualify for this capital gains exclusion if they meet these specific criteria. idea. Okay, let's move on. How do you actually transfer property? The first thing I'm going to say here is that it's always advisable to speak with a tax professional or an estate planning attorney during the process, because this is definitely something you do not want to get wrong. With that being said, there's several ways that you can transfer the property that allows for a step up in basis. Let's talk about two of the most common and straightforward. Number one is a will. You can transfer property to your children through a will by naming them as a beneficiary of the home, which means you retain full ownership and control during your lifetime, and the property only transfers to them upon your death. At that point, the property receives a step up in basis. Its tax basis is reset to the fair market value of the date of your death. So if your children later sell it, they'll owe little or no capital gains taxes on prior appreciation. This method is straightforward and ensures you keep full rights to use or sell the property while alive, and is often the most tax efficient way to pass real estate, though the property will go through probate unless placed in a trust. Number two is a revocable living trust. You can transfer a property to your heirs through a revocable living trust. A revocable living trust is just a legal arrangement you create during your lifetime to hold and manage your assets like real estate while still allowing you to remain in control. Revocable means you can change, update, or cancel the trust at any time, and living means it's made while you're alive as opposed to a testament trust created at death. To pass property onto your children through a revocable living trust, first you need to create the trust, name yourself as a trustee during your lifetime, then designate your children as beneficiaries. It's pretty straightforward. Then you're going to deed the property into the trust, but because it's revocable, you maintain full control. You can live in the home, you can sell it, or you change beneficiaries at any time. When you pass away, the property passes directly to your children without going through probate. It doesn't have to go through the banks, and they still receive a step up in basis to the property's fair market value at the date of your death. This will help minimize future capital gains taxes when they sell. And to be honest with you guys, this approach, it combines the flexibility and control for you with efficiency and tax savings for your heirs. Let's take a quick look at estate tax. The estate tax confuses a lot of people. Here's how it works. The estate tax is a tax on the total value of a person's estate above certain thresholds. So this tax is paid by the estate itself. In 2025, the federal estate tax exemption is currently $13.99 million. So this means if the estate value is less than that, then no federal estate taxes will be charged. So if you'll be leaving behind an estate that is less than that amount, you will not have to worry about the federal government taking a massive chunk of your estate through estate taxes. If your estate is larger than $13.99 million, then the percentage above the $13.99 million threshold will be taxed at the estate tax rates, which go as high as 40%. So keep in mind that some states also have their own estate taxes. So you should check to see whether the state you live in has estate taxes. One of the main things that people get confused about when it comes to estate taxes is that they think if they pass their home onto their children before they die, that their children won't owe any taxes on the property because the home's value is underneath the estate tax threshold. In a way, people who think this are right. The home will not be subject to estate taxes. However, here's the thing. If you pass your property onto your heirs before you die, even though you may avoid estate taxes, you won't be able to avoid capital gains taxes. So yes, your heirs could still owe a fortune in capital gains taxes. The only way to minimize your heirs' capital gains burden when you transfer your home to them is to make sure the property's value gets stepped up in basis by using techniques that we just talked about in this video. So you're starting to understand a little bit more how tax strategy and estate planning are kind of connected, and estate planning is arguably just as important as tax strategy, is it not? So we want to make sure the property value gets stepped up in basis by using techniques such as the ones we talked about earlier in this video. What about other properties besides homes? The way that taxes work for property other than real estate that is transferred at death varies from property type to property type. There are countless types of property, and obviously I can't cover them all in this video. However, here's a general rule. Most inherited assets receive a step up in basis to their fair market value on the date of the descendant's death. So this can include stocks, bonds, and even cryptocurrency. So as a guiding principle, one of the most important things you can do when passing assets onto your heirs is to make sure that the assets are stepped up in basis. Again, two of the best ways to do this are with a will or a revocable living trust. If you're nearing the age where you need to start thinking about all of this, then I highly recommend you look into these two strategies. If you don't have either of these yet, then you'll strongly consider getting one of them set up. The last thing you want after you die is have your children saddled with large capital gains taxes or getting into contentious arguments over who owns what while they're grieving your loss. Do them a huge favor and sort all this out before the time comes. If you have any questions about any of this, then I highly recommend that you reach out to my team by clicking on the link below in the description. We'd be more than happy to at least have that preliminary discussion or route you to the right attorney. I just want to say thank you so much for making it all the way to the end of this video. I hope that you found value from this video. We do a great job on this channel to try to educate you on complex topics to simplify it so you can leverage the tax system. My name is Karlton Dennis. Thank you so much for watching. I look forward to seeing you on the next video. Cheers.